Okay, everybody. We're going to go ahead and get started here today. I would like to start off by asking Wally Obermeyer to open it up for us.
All right. Well, thank you, Brian. Hello, everyone. Thank you for joining us today. I know many of you, but for those of you whom I haven't met, I'm Wally Obermeyer, president of Obermeyer Wood, and I'd like to welcome you all to this call. Thank you for being a client or a prospective client. We appreciate your trust in us. We take very seriously our responsibility to carefully and intelligently manage your investments and to help you with your financial planning. We are driven by a mission to help grow and secure your financial future and to deliver peace of mind. We understand it's a challenging time, and we welcome you reaching out to us with questions, concerns, and with anything at all that we can help you with. This should be an interesting discussion today. The format will be that Brian Brady, our Director of Marketing and Communications, will be interviewing Maia Babbs. Brian will introduce Maia. There'll be a discussion followed by a Q&A session. We aim to wrap up in an hour or a little bit under. So again, thank you, and we'll get started.
Great. Thank you for that, Wally, and welcome everybody to today's Obermeyer Wood Investment Council client webinar for the month of June. I have met some of you. I haven't met many of you, but my name is Brian Brady. I am the Director of Marketing and Communications at Obermeyer Wood, and I'm going to be your host and moderator today. So much like Wally said, I just want to reiterate on behalf of all of my colleagues, I'd like to really thank you for joining us today. Given the extraordinary times that we're living in, we really find it more important than ever to be available, to be communicating, to be talking to all of you, because, frankly, we all need support during this time, and we're here to offer it. So thank you for your continued partnership and trust in us. Again, I speak for all of us when I say being your financial advisors and your just general sounding boards. It's really a calling for all of us, and we treasure the relationships that we've formed with so many of you over the years. I'd also like to take this opportunity to let you know that today's event is the latest in our monthly series of virtual events that are scheduled for on or around the third Thursday of every month. Now, I say around the third Thursday because some months will need to be a little bit flexible depending on topics and speakers' schedules. Like last month, we secured a non-Obermeyer Wood employee to do a presentation, so you have to be a little bit flexible in times like that. But we are tentatively planning our next event for July 16th. We're still finalizing the speaker and topic, but keep an eye out for communication in the next probably week or two, inviting you to that. So you'll, just like you did for this event, you'll get an email. And yeah, we're really encouraged by the attendance today, and we love doing this. So, as Wally mentioned, our featured speaker today is Maia Babbs. She is Vice President of Investments and Client Advisory and also a partner at Obermeyer Wood. Before I go any further, I would like to kind of cover some operational details about the webinar today. We are operating in a virtual environment. Some of us are in the office, some of us are at home. We're complying with all the local rules and regulations, but as part of that remote environment, there could be unforeseen technical issues. Obviously, we don't plan for that, but they do occur sometimes and can be out of our control. But if you experience any difficulties, please call our Denver office at 303-321-8188. We have members of our team standing by ready to assist you if you need, any guidance on how to rejoin this call. We would also like to remind you that we cannot discuss any specific details related to the performance of individual stocks during today's presentation and the accompanying Q&A. That is an SEC regulation. Obviously, we operate well inside those bounds, and so just wanted to make that clear, before we get into the Q&A, that if you ask about specific performance, we'll cover it to the extent we can, but we can't really get into a lot of that stuff. What we are going to cover today is our firm's investment philosophy, the process on how we come to decisions for client portfolios, And then we're also going to provide market commentary and observations on what we view as a broad range of investing topics. And we really hope that you'll enjoy those. And finally, I do want to let everybody know we are recording this webinar. Many clients who couldn't join the live version were really interested in getting to hear it. I do want to assure everybody that we are very careful about personal information and protecting client anonymity when appropriate. So we will use editing software to make sure that nobody's names, photos is part of that recording and distribution, but you probably can see somewhere on your screen that it's being recorded. So I just wanted to cover that for you. So with that, I would like to share a slide for you guys. And we'll be sharing a few slides today, and we'll kind of be toggling back and forth. But I want to begin by introducing our speaker, Maia Babbs. I know a lot of you know Maia, but for those of you that don't know her, I'd like to kind of go through a little bit of her bio. Maia Babbs has over 20 years of broad financial industry experience, and she's been with Obermeyer Wood since 2015. In addition to her tenure at our firm, her experience includes working as an equity research analyst at both Janus Capital and Denver Investment Advisors, a senior associate at investment banking firm Green Manning Bunch, and an associate in Deutsche Bank Securities Debt Capital Markets Group. Maia received her BA in Foreign Affairs from the University of Virginia and her MA in Law and Diplomacy with a concentration in International Economics and Finance from the Fletcher School at Tufts University. Appointed by Governor Hickenlooper in 2015, Maia served as commissioner for the Colorado Commission on Higher Education. She was the chair of the Fiscal Affairs and Audit Committee, and she was appointed to the Funding Allocation Model and Affordability Subcommittees. Maia was also elected to the Genesee Fire Protection District Board of Directors in 2018 and served as treasurer for that organization. In 2019, Maia was appointed to serve on the Board of Trustees for the University of Northern Colorado by Governor Polis. And of course, in her day-to-day work at our firm, Maia performs security analysis and manages client relationships. So with that, Maia, I'd like to start our conversation here. Obviously the topic is our investment philosophy. That's the headline topic. So it's a great place to start. And I'd like to start by asking you to give a brief overview of our investment philosophy. We believe our valuation-oriented philosophy and our independent perspective help us protect our clients' net worth while also delivering attractive long-term returns. Can you really do a deep dive into our investment philosophy for us here?
Sure. Thanks, Brian. And first, hello to everyone, and thank you very much for joining us today. It's wonderful to have you with us, particularly as we seem to be getting into the later stages of the pandemic and quarantine. And I didn't even think about the fact that this is lunchtime. So thank you very much for doing a working lunch with us today. We appreciate it. And I see many of my clients on the call. It's great to have you. So today our goal is to explain our investment philosophy and process here at Obermeyer Wood, explain why our approach is different and why we think that best serves you, our clients. The intent is that our conversation today helps to provide you with peace of mind as we navigate these volatile markets together. Our investment philosophy here at Obermeyer Wood is relatively simple. We identify high quality companies and buy their stock at bargain prices. Brian will share his screen, which has a slide that summarizes our philosophy and approach. I'll walk you through this, but we'll just give you a few seconds to review it first. First, we focus on owning high quality companies. So what is it exactly that makes a company a high quality one? When we're reviewing all the companies we could own, we're looking specifically for companies which have what Warren Buffett calls a durable competitive advantage or moat. Think of a castle and a moat. The wider it is, the more alligators in the moat, the better it is, and the better protected the people inside the castle are. With companies, competitive moats can be things like patents, like you see in the pharmaceutical or technology industries. Or a competitive moat can be a highly valued brand. Think of Coca-Cola or Mercedes-Benz. Or a competitive moat can be the ability to manufacture something at a lower cost than your competition. This competitive moat protects a company's castle, so to speak, which includes its market share and its profits. These types of special companies typically generate strong revenues, and profits over a very long time period and generate substantial amounts of cash. In addition to a competitive advantage or moat, we're also looking for companies that have strong management teams and attractive growth prospects. So there's a long-term potential for strong investment returns under stewardship that we trust. Lastly, we make sure that the companies that we invest in have strong financial returns. So what is that? It means that they're able to earn substantial profits or earnings with limited investments in things like their factories, equipment, and inventory. We also ensure, just to be careful, that companies have strong balance sheets, meaning that the debt they have is sustainable, and access to liquidity and ample cash. We then value those companies, which is a fancy way of saying that we figure out how much the stock is worth using our proprietary financial models and compare it to where it's trading in the market. If we think that the stock is worth substantially more than the price at which it's trading, it's a bargain and attractively valued. So for example, if we go through that exercise and we think a stock is worth $100 and it's trading in the market at $50, that's a good stock. If it's not, often a stock is trading around that value that we come up with, or maybe a little bit higher, and then we wait. Often you get those types of opportunities to buy the stocks that you're waiting for when there's significant market downturns, or if there's specific negative news or misunderstandings related to the stock that may just be short-term in nature. And then the last bullet point, another key piece to our process is portfolio construction. We aggregate all of these stock ideas into a diversified portfolios for clients, ensuring that the stock we're adding fits within the portfolio and our risks are effectively diversified. So how we invest is unique. Our investment approach is unique, and it's premised on the idea that our portfolio holdings aren't just pieces of paper. They represent ownership in real companies. The reason that we invest in this careful way for clients is because I and all of us at the firm strongly believe that this philosophy and process delivers strong risk-adjusted returns over the long term with appropriate diversification and risk management. Careful, methodical investment management, capitalizing on market opportunities, is at the core of a sound long-term financial strategy for our clients, and we're laser focused on it here.
Thanks, Maya. I was thinking about what you just said, and I think it's important to point something out. And again, I think a lot of our clients know this, but I want to point out a differentiator for us. We pick individual stocks, which isn't always the case in our industry, where a lot of advisors put clients into funds. Can you explain to folks why it is that we do that?
Right. Yes, absolutely. That's correct. I mentioned that we're unique in that we spend so much time and effort following overall financial markets as well on individual stock research and selection. So Brian, if you don't mind moving to the slide that shows our investment process, again, I'll pause just for a few seconds here. So here at Obermeyer Wood, we have a highly experienced analyst team with decades of experience in individual stock research. We all have been following the markets and stocks for decades, and we've worked on Wall Street for hedge funds in the corporate world and for large mutual fund firms. As well, among our Obermeyer Wood team here, we have 5 chartered financial analyst charter holders and 1 level 2 candidate. To attain this credential, we had to pass 3 6-hour examinations, study over 400 hours on investments, financial analysis, and portfolio management. And if my colleagues are like I am, I missed a lot of skiing. We leverage our experience as we constantly scan the markets and companies to identify potential investment opportunities. This initial stage, scanning the market, looking for potential ideas, and monitoring stock price movement, is the idea generation part of the process, the very top of the funnel that you see on the slide. Once we've identified attractive opportunities, we discuss them as a team in brainstorming sessions. And then if the team likes them, we dig into them more in depth and do very intensive research and build and create long-term financial models for each company we're interested in. Once that work is done, that stock idea is then formally presented to our investment committee by the analyst, and the committee debates the pros and cons, and this can sometimes be a very lively debate. Only the best stock ideas, both in terms of company quality and the price we're paying for them, get approved for inclusion in the portfolio. The stock is then weighed against the rest of the portfolio to ensure that the overall portfolio is adequately diversified. And once the stock is purchased, we actively monitor it, watching quarterly earnings reports, reviewing company news, and meeting with management and competitors to keep our eye on it. So this approach also allows clients to understand the individual stocks they own and the rationale for owning them. This is beneficial, particularly when you have times like we've had in the last several months, these very high volatility kind of times of market stress. And understanding the strength of the companies in your portfolios helps provide additional confidence through challenging times in the market. So, Brian, like you said, our investment approach focused on this individual stock selection is unique. And it really is in contrast to what many other firms do. Many other firms simply use pre-populated investment portfolios using index funds or mutual funds or some kind of combination of them. So this saves these firms substantial amounts of time. However, the challenge with that is that there just simply isn't the possibility to select the stocks with the best opportunities. With index funds, you simply take with what you get, and ultimately you don't really know what you own. You own a lot of different things. As well, the funds, these ETFs and mutual funds other advisors are using are placing bets. So they're placing bets on markets, industry sectors, currencies, etc., and those bets may or may not be correct. As well, many mutual funds charge substantial fees, which we try to avoid for our clients. Our approach, identifying high quality companies and buying them at bargain prices, takes more people hours, effort, and investment in specialized tools like Bloomberg terminals, which is a specialized service where we see stock pricing and movements every day. However, the reason we do that is because we strongly believe it's the right way to invest for our clients.
Great, yeah, and I think that's so insightful. I'm smiling because I know the spirited discussions that you guys have. It's a shame we can't have them all in person lately, but I do think it's really important for clients to know that just how much kind of blood, sweat, and tears goes into what you guys are doing on a day-to-day basis in your research and discussion process.
Yeah, absolutely.
I think it's really great. I think another thing that I wanted to cover a little bit. And again, a lot of our clients are familiar with this, but we are long-term in our view on investing, and as part of that view, we tend to discourage the strategy of making buying or selling decisions of financial assets, most times stocks, by attempting to predict future market price movements. Some of you may know this. The principle is known as market timing. Can you go deeper into why we stress a long-term approach and discourage market timing?
Yes, of course. First, we think about how long many client accounts took to build. They're the product of decades of hard work and savings. And our duty here at Obermeyer Wood is to protect and grow those assets for you. So the reason we focus on the long term is because short-term market timing tends to be emotional and reactive and not based on facts. Basing decisions on emotions often leads to overly hasty or incorrect decisions and can destroy portfolio value. There are these things called behavioral biases, which can drive market timing, this market timing behavior. So what behavioral biases are human behaviors which can lead to incorrect investment decisions. So examples of behavioral biases are overconfidence or risk aversion. With overconfidence, an investor can take on too much risk at the exact wrong time. And with risk aversion, too little. We also emphasize long-term investing because we believe we have the best opportunity to identify mispricings or bargains, as many market participants focus very myopically on the next earnings report or the next few months or the next data point. Thinking long-term allows us to look through short-term disruptions in stock price volatility and focus on the real value of businesses over the very long term.
Great, yeah, and in these last few questions we've covered a lot, and I think it would be interesting to walk folks through our exact internal process, because we do have such a disciplined approach to idea generation, research, discussion. Can you talk about that what we call our independent and disciplined approach, and what that entails. And then second part of your question, I know nobody likes two-part questions, but maybe even walk us through the entire life cycle on how, an initial bright idea eventually becomes a purchase that ends up in a client portfolio.
Yeah, absolutely. Yeah, this is really kind of the sausage making part of kind of the process. It's just in sort of thinking about my comments, I may have made the sort of stock research sound a lot easier than it actually is in practice. And so, yes, I'd be happy to go into the detail on a life cycle of an idea. So identifying a stock idea means that each analyst monitors hundreds of stocks regularly, follows specific industry sectors, reads as much as possible, and attends industry conferences. For example, I attended the Consumer Electronics Show in Las Vegas earlier this year when we were still able to attend conferences to search for new ideas and to check on current holdings. We do all of this looking for potential investment opportunities that the market may be missing. Each of us kind of at this stage as individual analysts do quite a bit of work. So this includes running companies through valuation models, learning about different companies and how they make money, etc. We meet as a group to brainstorm ideas and then proceed with intensive work on the ideas that the team thinks are the most interesting. That next stage of work includes understanding how the business works in detail. And so this is just very simplistically how the company makes money, which sounds very simple, but in some cases can be quite intricate and detailed, and matters quite a bit when you're considering the accounting of these specific companies. The analysts also come up with, kind of during this stage of the process, what the specific investment thesis is. So what an investment thesis is are the specific reasons we think the stock will go up. So what is going to make revenues go up more than the market expects? Or what will make earnings or profits go up more than the market expects? This typically outlines why we think the company's prospects are misunderstood and why the stock is an attractive opportunity. So this stage also includes detailed financial modeling, and there we try to quantify how much a stock would be worth if what we're projecting is correct. And then we also provide a reasonable range of positive and negative outcomes, because what we're really doing is guessing about the future in a very sort of highly educated way. So that range of negative outcomes we distill down into specific cases. So we have a base case, or the case that we think is the most likely to happen, and then a bull case, which is, when many positive things may happen, and in addition, a bear case, which is a case where, things may not be quite as rosy as we're assuming in the base case. And so we really sort of frame the range of outcomes. During this step in the process as well, we create price targets for stocks. Then, as I talked about earlier, the idea, kind of the research piece, as well as the model, and any kind of supporting materials, which can include company presentations, etc. All of that material is presented at our investment committee. And the investment committee has all had a chance to review the materials in depth before and do any work that they need to do on their own prior to coming to that meeting. There's the idea is presented, it's debated, often can be quite active debate, as very important that everyone understands the pros and cons, risks and rewards of a potential idea. And then ultimately a decision is made on it. We have a sort of proper vote. In some cases, follow-up work is necessary. And so in that case, the analysts follow up to the team on, with the additional work, and then a vote is taken later. So for every stock that's in a portfolio, every stock that you see purchased in your portfolio, there's hundreds that don't make it, and many hours of work, both on the analyst part and on the investment committee's part behind it.
Right. That's great. I'd like to think about what we just covered as in so far in our conversation are the things that we do our best to control, our processes, our philosophies. And now I kind of want to focus on what I think a lot of people are probably thinking about. And that might be the things that we can't control, and that's current market conditions. Since late February, which I think I speak for a lot of people, feels like forever ago, but volatility has been front and center. And despite the recession that we know we're in, the stock market has been doing surprisingly well over the last few months. Can you give us your thoughts on this?
Sure. Yeah, thanks, Brian. I've spoken to many of you on this, kind of given the intense market volatility we've experienced and this sort of perceived disconnect between what the market is doing and what the sort of real economic reality is. So just to frame kind of our situation, we didn't just have a pandemic caused by the COVID virus, we also had an oil price collapse as well. So that did not get as much press, but the disruption in the oil markets created quite a bit of additional market stress. So today, happily, we've had a strong market recovery after the lows in March, driven primarily by the fast, massive stimulus and market support from the Federal Reserve, the Treasury, and Congress. And today, while concerns of a second wave of infections still loom, in many areas, the virus appears to be slowing. Potential vaccines are moving into advanced trials in July, with one particular vaccine in phase 3 trials as early as July. And the debate in the market that we see is really how much economic damage has been done and what an economic recovery will look like. From our viewpoints, there remains a very broad spectrum of outcomes still, including a best case scenario of limited economic damage, a recovery in 2021, and a market awash in liquidity provided by the Fed, which is typically a very good backdrop for equities. And this is the scenario that the market appears to be reflecting, particularly on good days. However, on the downside, there could be a real second wave and a protracted recession. So you're getting this push-pull in the market right now. And to add even more excitement, we have US elections in November, raising questions about how a second Trump administration or a new Democratic administration could handle a federal response to economic problems. So we've intensively reviewed our portfolio for COVID exposure and have ensured that we have a balance of stocks that we believe have attractive prospects across this broad range of outcomes.
That's great. That's great insight. And I want to take a moment to time out here. We're about halfway through our interview discussion. I'm sure some of you folks have questions you want to ask about volatility or about our process. Now would be a good time to introduce to you the question asking process. You can ask them now, but just be aware we're not going to answer them until the end of our conversation. At the bottom of your Zoom browser, if you hover over it, you will see a chat button. You are more than welcome to ask questions in that chat, and I will read them to Maya at the appropriate time. If you're more comfortable emailing them directly to me, you can do that as well. My email address is Brian with an I, B-R-I-A-N, @obermeyerwood.com. But so yeah, feel free to ask questions now, and we'll get to them when we get to that section. But moving back to our conversation, what we just covered with volatility, we've heard from a lot of clients that are curious about how we view opportunities during this time. And you touched on that briefly with the equities landscape during volatile markets, but can you dive a little bit deeper into, kind of what we're looking at?
Sure. Yes, so for us, market downdrafts can be a wonderful opportunity to buy stocks that we've had our eye on for bargain prices. I always liken it to everything going on sale at the Cherry Creek Mall. Many of us would drive right over and buy that Chanel jacket at a huge discount. While market downturns don't feel very comfortable, often this is when we get great prices on stocks. We follow Warren Buffett's advice: be fearful when others are greedy, and greedy when others are fearful. So I do want to note that we expect volatility to remain elevated. Right now, our current climate is highly unusual and unprecedented. We view this pandemic as a type of natural disaster, which effectively shut down the global economy for months, something that's never happened. And no one can really be clear on sort of what happens as we emerge. The stimulus the government provided is providing short-term life support to the economy until we emerge from this pandemic, which we're finally starting to do. However, that stimulus creates distortions in numerous markets. So right now, it's very difficult to see what the true, real underlying trends are. So over the next 6 to 18 months, we will see the true economic damage, and that may be better or worse than current expectations. Over that time, we'll continue to see more volatility as expectations change and volatility remains elevated. I will note, this is an interesting item. It's just interesting that the market dislikes uncertainty more than actual bad news. Overall, we're watching the markets very closely and we'll take advantage of opportunities that we come across.
Well, I think this moves us well into the direction of our next topic. And I want to talk about a few different areas. Most of them pertain to kind of buzzwords that folks might hear a lot. You know, if you're watching TV and a TV commercial comes on for a brokerage or a custodian or something like that, you often hear the word diversification. And, you know, kind of doing 101 work here, can you explain what a diversified portfolio is and why it's so important?
Yes, absolutely. It's incredibly important, and it's used very frequently, kind of, and I'm not sure it's very well understood. So at its very basics, diversification is the practice of spreading your investments around so that your exposure to any one type of asset is limited. It can mean across different asset classes, which means the percentage of stocks, bonds, or cash that you own, or it can mean the diversification within those different security portfolios. For example, diversification within a specific equity portfolio. So it's important to remember that the primary goal of diversification isn't to maximize investment returns. The primary goal is to manage risk and to limit the impact of volatility on a portfolio. It's a bit like saying no one can know for certain who's going to win this race. So let's spread our bets out across a bunch of very good racers. So in terms of portfolios, diversification means holding investments which will react differently to the same market or economic event. We pay a lot of attention to this. It's a very important aspect of our risk management. And so we also look to diversify the portfolio in terms of sector exposure. So what sector exposure is we have a variety of industry sectors represented in our portfolio. So for example, healthcare, technology, and consumers are all examples of different types of sectors. So we make sure, again, to use the race analogy to spread our bets out across all of those different sectors so that clients aren't overly exposed to one industry or another. Diversification is very important in investing because markets can be volatile, as we all know, and unpredictable. And achieving these long-term goals requires actively balancing both risk and reward.
Great. And I'm glad we covered risks there, and we may end up coming back to it shortly. But I also want to talk about some other kind of principles in stocks specifically that, you know, some of our clients might hear if they have CNBC on or other market coverage programs. And that has to do with cyclical versus defensive stocks, sometimes known as non-cyclical stocks. So especially during these tough economic times, this can be a very important topic. Can you explain the difference to us between cyclical and defensive stocks, and also discuss why owning stocks in these two categories is important given what we had just covered pertaining to market volatility and just general market conditions?
Yes, absolutely. So the first thing I just want to sort of make a broader comment about this because so I just want to make the point that the news media, both kind of traditional broadcast news and online platforms, they make their money on attention. So either in viewing audiences or clicks on your phone or computer or iPad. The more fear and concern they create, the more you watch TV and click on your phone, computer, etc. And so sometimes the best thing to do is to turn your devices off or to call us if they're causing you stress regarding your investment portfolios. So here at Obermeyer Wood, we have a balanced approach, which means that we consider both risks and opportunities in the markets. During market turmoil, we focus on protecting your assets and taking advantage of market opportunities we're finding. So as I mentioned before, our team has years of training and experience, which means that our job is to remain calm during these times. It's a bit like firefighting. We're trained not to run away from the burning building. This is important because that training allows us to do the exact opposite of what the rest of the market is doing, panicking and selling indiscriminately. Instead, we continue to scan the market and look for great investment opportunities at bargains, which is exactly what you get at times like that. So with that said, let's talk specifically about what cyclical stocks actually are. So broadly, they're stocks that tend to move up and down with the overall economy. It's a common mistake to lump all the cyclicals together. In reality, there's a tremendously wide variety of stocks called cyclicals, and they range from auto manufacturers to clothing apparel companies to banks to industrial companies. So across the cyclicals, the companies are driven by completely different subcycles. For example, the real estate cycle, the consumer spending cycle, an insurance pricing cycle, a credit cycle for financials, or what we call a capital expenditure cycle, which is the propensity for companies to buy equipment. So companies within cyclicals have completely different fundamental drivers. A restaurant company versus an aerospace company, for example, yet both are considered cyclicals. In addition, each company has its own particular situation and may have attractive investment prospects for reasons completely unrelated to the overall economy. It's also a common mistake to avoid all cyclicals in times of market stress, particularly when there's the prospect of a downturn, without differentiating between companies or business prospects. This approach can overlook real opportunities within the cyclicals. In some cases, the market has beaten up some of these companies so much and expectations are so low that it's very easy to have strong investment returns if the economy or company does just slightly better than what the market is expecting. So that's cyclicals. So another type of company is a company called defensives. Defensive stocks are really the opposite of cyclicals, and those include companies such as consumer staples companies, utilities, and drugstores. These companies tend to have steady eddy, slow growth, much more insulated from volatility. The challenge is that these types of companies tend to be more expensive, as many market participants will pay a high price for certainty, making bargains harder to find. So a third type of company that we try to look for is a type of company that is a secular growth company. So this is a company that has some trend driving it that's broadly independent from the market. For example, the uptake of cloud computing, the move towards increasingly autonomous driving, and the increased usage of electronic signatures are all examples of growth trends that don't depend on the broader market. So we focus on the quality of companies here at Obermeyer Wood, and it's important to note that many cyclical companies have strong competitive moats and strong financial fundamentals. And we look to buy those high quality companies at bargain prices. When putting together a portfolio, particularly in market circumstances like we have today with such a broad spectrum of outcomes, we look to create a balanced portfolio and include defensives, secular growers, and cyclicals so that we can position the portfolio to provide strong investment returns across a wide range of potential economic outcomes.
Thanks, Maia. I know that was a lot to cover, and it was another two-part question, so I apologize. So we have several questions that are already come in. I want to make sure that we have enough time to get to all those, but let me just kind of quickly wrap up the conversation piece that we just had. You know, what we wanted to accomplish today was to explain to you how we invest. We look at high quality stocks at attractive prices, and then we build diversified, balanced portfolios. And so hopefully we've explained that, and also why our approach is unique. And we invest this way because we believe that it's the best way to serve our clients, and it positions them for the most optimal way to achieve long-term financial goals. So I hope we've achieved that. I really thank you, Maia, for your expertise in this area. And I'd like to get to some of the questions. So again, want to remind folks, we have about 17 minutes. I want to remind folks to submit them in the chat box at the bottom of the Zoom screen. And also just another reminder, we cannot cover performance of individual stocks due to SEC regulations, but we're happy to answer as much as we can here. So the first question, Maia, that I want to cover, can you explain your decision-making process relative to when we decide to sell positions?
Yes, so this is sell, thank you for the question. So our sell discipline and just sell disciplines in general are incredibly important to the success of an investment process, and to kind of strong investment returns. So like I mentioned kind of at the very beginning, and kind of through our conversation today, part of our process is analysts creating an investment thesis, which again, just as a reminder, is when the analyst outlines exactly why we should be buying the stock and what's misunderstood about the stock. And as part of that, they also assess a value, and that is really the price target. And so there's those two are sort of critical pieces in the sell discipline. So the best possible time to sell is when you're absolutely right about the stock. You bought it at $50, it went to $100, $100 was your target price, and it hit it, and then there's no further upside in it, and that is when that's when it would trigger a sell. In other cases, what happens is you have a violation of the investment thesis. And that happens in cases where it just happens as part of kind of overall investing, and you try to limit it. But that happens when kind of the original sort of reason that you bought the stock actually doesn't come true. So for whatever reason. So for example, we bought a building products company several years ago, and the investment thesis was that the overall market had turned effectively into a duopoly, and that had really been broadly overlooked by the overall stock market, and the stock was worth substantially more. So that was one part of the investment thesis. The second key piece of the investment thesis was that the company was going to be able to take out substantial amounts of costs because they had just acquired another company, and they were going to combine operations, make their building products in a much more effective way. So what happened is, we own the stock for 6 months or so, 8 months or so, and unfortunately what happened is a court ruling went against them that disallowed effectively the ability for the companies to shut down and then optimize kind of the factories and then their cost footprint. So in that case, that's an example of when the investment thesis was violated. It doesn't happen very often. We like it that way, but when it does happen, the analyst, it's very difficult because the analyst has spent a lot of time reviewing a particular company, but it's extremely important to kind of stay disciplined in these times, and we sold it as soon as that happened. And that's just one of those things that happens. As well, just the sell discipline, we also kind of think about selling just with regards to the overall diversification of the portfolio, because we want to be sure, like I was saying, that we're appropriately diversified. And so depending on kind of how the market changes and where our opportunities, our valuation opportunities are, where things are trading, we'll make adjustments to kind of the stocks that are owned and the sizes that they're owned in our portfolio. And so that is also kind of when we would sell stocks. So those are all kind of the components of our sell discipline. And it's something that we've created. It's a formal document, and it's critical to kind of maintaining sort of investment discipline kind of as a team.
Great. Thank you. The next question is really interesting. Has to do with a more behavioral aspect to what you all do in investment committee. The question is, in investment committee, if everyone is in agreement, how do you avoid groupthink? Who gets to be the devil's advocate?
So we don't have this problem. We don't have this problem. So we actually have an investment team that comes from sort of a broad array of backgrounds and has a broad array of expertises in different sectors, et cetera. And so in general, the power of that is that I think fundamentally teams make better decisions because they come to the room with different views. You're able to debate. Often kind of what comes out of that debate is something that the analysts may have missed or not thought about, more risks that get considered, et cetera. So groupthink is certainly not a problem at all kind of on our investment committee. You do want to, it is just something kind of behaviorally to just be concerned about. And I think, it's a natural inclination of all of us as analysts to kind of view things as both a risk and an opportunity. So what can go right? So this investment thesis of what can go right, and then what can go wrong. And so in the long pieces that we do as part of the presentation to the investment committee, there's a very kind of long portion of that that's specifically allocated to the risk, to kind of the risk piece of this. And so in that way, we're not just considering kind of the positives, because you can get very sort of caught up in how great everything is and how everything will turn out. But then also, we spend a lot of time kind of talking through the risks. The other thing that I just highlight here on the groupthink is also about, this kind of bull bear base case, that really, a part of our kind of power as a team is, again, sort of we are able to kind of think through what reasonable kind of bull, bear, and base cases are and quantify them. So we know exactly sort of, within reason, if something goes badly, whatever the devil's advocate would be arguing for, if something goes badly, how much could you potentially lose on this stock if you're wrong? And if everything goes well, how much better the stock could be, beyond that $100 that I was originally talking about. So we try to frame kind of the range of outcomes, because what we're looking for is sort of asymmetric risk reward. So stocks that have very good sort of investment return potential with limited risk. So we're looking for these, I can't remember the exact Warren Buffett quote, but we're looking to kind of drive our trucks across or step across kind of the 3 foot, the 3 foot gates instead of trying to leap over the very high fences. There's a specific Warren Buffett quote. I'm sure Wally knows it. So groupthink is not a problem, but it's definitely something to kind of consider. And it's also something that we think about a lot kind of in terms of our sell discipline, and make sure that, we're all sort of coming up with, we're weighing both the positives and the negatives. So we embed that into our actual investment process in terms of how that, gets reflected in the actual document, the research document that we put together, but then we also embed it into our modeling.
Great, thanks. Yeah, and I'm smiling a little bit because when we are all together, sometimes I see the investment committee getting ready to go into a meeting and discuss things, and it's like watching athletes about to run out of a tunnel or something. Everybody's got their adrenaline up and ready to have a spirited, healthy discussion. So that's great. Next question is, where do bonds fit into our strategy?
Yeah, that's a great question. So bonds, and this is actually a very individualized kind of answer. What we didn't really talk about as much today is kind of broader asset allocation. We talked a little bit about that, kind of our conversation about diversification. So what we talked about today was solely sort of the equity piece of our investing, but of course, a broader asset allocation for many of our clients includes equities, bonds, and cash. And that really depends on an individual client's needs. And so that is determined by risk tolerance. So what is a client's time horizon for whatever goal they're trying to achieve? So are they trying to retire in the next 10 years, 20 years, 30 years, et cetera? So time horizon is a big piece of that. And then the second piece of it, is just an individual's kind of personal risk tolerance. So bonds are often used as sort of a cushion, with cash as sort of a cushion to an overall portfolio, where they really provide sort of stability through kind of good times and bad times. And so an individual's risk tolerance can drive an increased allocation to both fixed income and cash. particularly if they're less personally tolerant of kind of big swings and kind of market volatility. The equity market, as we know, is volatile and, can be very volatile, like we've seen kind of most recently and kind of into the future. But bonds and cash allocations can absolutely play a part in kind of in clients' asset allocations. And so, we've talked about kind of the investment management piece and the equity management piece of client portfolios, but this fits kind of within a broader sort of financial strategy that we work on kind of with our clients. And so for an individualized bond strategy and how it fits and, may work for you, that's something that we really spend a lot of time with clients. And to the extent that you have questions about it, or anyone does kind of on the call, I'd encourage you to reach out to your relationship managers to check in with them on it.
Great. Next question, another great question. Is your team continually monitoring individual portfolios and any significant gains which can be offset by losses in order to minimize tax consequences?
Yes.
Okay.
So that's a very good question. There are a few just things to think about when it comes to taxes and investing. So first of all, our kind of rule of thumb here is that we don't kind of let the tax tail wag the dog, sort of the proverbial dog. And so we ensure that investment decisions are the key decisions when we're buying and selling kind of investments for our clients. Because you can get into trouble if you start worrying about holding for too long because of tax consequences, et cetera, beyond when that particular holding has what the investment team sees as upside. So that's just the first sort of overall comment. The second comment is, where we have substantial gains, a risk management practice just on the investment committee is to ensure that we sort of take those gains sort of gently off the table over time and don't allow kind of those positions to grow sort of substantially, so that they do create kind of these big tax consequences when they're sold all at once. So we try to manage that so it's just a smoother function. I will say that we also very much focus on individual clients' specific tax situations. So in some cases, some clients have very big gains or losses that year, and they need kind of a specific, and they ask, and we work with them, work with them and their CPAs to just ensure that investment gains that we take, investment losses that we take really conform and dovetail into kind of what they need sort of personally on the tax side. But as a general approach, we don't try to kind of let the sort of tail wag the dog, so to speak. And the other thing I have to sneak in is I know taxes are such a kind of sore point and, everyone hates them. But, investment taxes, capital gains taxes and taxes on dividends are the lowest, the lowest taxes that you can take. And so, no one likes paying them, but the reason you're paying capital gains taxes is because you've had a big winner. And so I just want to remind, no one likes paying taxes, but these types of taxes are lower. And it's because, to the extent that you're incurring a taxable gain, it's because you've had a great winner in the portfolio. And that's really kind of what we're going for, is overall kind of winners across the board.
Got it. So we have time for one more question. And I know you have personal experience with this, Maia, sitting on University of Northern Colorado's board. Given the economic shutdown, a number of municipalities and states are running on decreased revenues, with corresponding increases in expenses due to everything we've been going through. So what does this mean for debt markets?
Yeah. So that's a great question. So yes, I just joined the University of Northern Colorado's board, and they had been running at sort of a deficit, which they tried very hard to kind of fix and had done so. And so they were positive on cash and were adding to their cash reserves. They were not, they were at an equal budget. So they'd done a great job before this pandemic. So after this pandemic, it's a completely different situation. So overall, you know, these schools, higher ed institutions in Colorado, are driven by enrollments, which are going to be negatively impacted by what's going on. As many students opt to take gap years instead of, you know, studying online or on hybrid programs. And state funding really just sort of got a hole blown through this whole, you know, pandemic, both in the response and in kind of significantly lower tax revenues generated because of the kind of economic challenges. So it's, you know, state budgets, it's municipalities, it's any type of, you know, institution which depends on state funding. So it's not just higher ed institutions, it's K-12, it's prisons, it's roads, it's just across the board. So unfortunately, kind of this year and next year, expect more potholes, expect more kind of cutbacks in schools. It's really unfortunate and a, you know, a tremendously bad situation. Federal funding offsets this slightly, you know, for the short term, but looking into next year, you know, I referenced sort of the uncertainty around the political situation. It's very sort of unclear, you know, what 2021 and 2022 hold. So as it relates to the debt markets, you know, this is really the sort of muni market, and that is actually a very kind of specific market. So many muni, let me translate here for a second. Muni is short for municipal and includes obligations backed by certain types of, you know, cash flows. So for example, you know, a water facility can generate a revenue or a cash flow stream to back a municipal bond. So investors like them very much because they're tax efficient. So this is really kind of very specific, and, you know, it gets very granular. And so it really depends kind of municipality by municipality. So, you know, where you are is very important. So municipalities in, you know, Nevada or, you know, Florida, Orlando, for example, are going to be very kind of badly hurt potentially. But then it also depends on the type of actual sort of asset that's generating the cash flows. So if you're water, you know, that's potentially fine. So you need to be very, you know, back to kind of the nuance that I was talking about with approaching cyclical companies. You need to be very nuanced with how you're approaching kind of certain sort of credits in the debt market. The other thing I'll say is the Federal Reserve flooded the market with massive amounts of support. And, you know, across this, you know, the part of the government stimulus included, you know, the revival of many programs that we hadn't seen kind of since the financial crisis, you know, lending facilities, direct buying programs. And so across many markets, the Fed has kind of stepped in to support kind of credit markets. This doesn't include kind of the high yield markets and some structured markets. So that's just another kind of aspect to think about when you're thinking about sort of the, you know, the impact of this on the debt markets is the Fed's involvement and how kind of massive and significant it is. They're really providing this sort of, you know, hand of God under kind of the higher quality credit markets.
That's great. All right, well, it is 1:02 p.m. Maia, I want to thank you for your time today and for everything you shared. I think I speak for everybody when I say that definitely learned a lot today. And I want to thank everybody that's attended. It means a lot to us. And again, we just value our partnership with you so much, and we're excited to continue to hold these events with you in the future. As I mentioned at the outset, for any of you that weren't there at the very beginning, we are going to be doing events like this monthly. We are going to vary the topics. So sometimes it's going to be things right in our wheelhouse like this. Other times it may be things related, you know, we might have a guest speaker related to arts and culture or health and wellness. So really trying to provide value and yeah, just be there for everyone. So again, thank you for your time. We will probably be reaching out to you all for some feedback to find out what you thought, how we can improve. But yeah, just thanks for your time, and I hope everybody has a good day.